Toronto Dominion Bank says there could be a more extended downturn in the Canadian housing market. So let's get right into it and see what on earth they are saying. And please stay to the end of this video because I'm going to be going through some examples that really show the bubble between Canada and the US, where we've got houses that are so close to each other yet miles apart in pricing. So let's get into it and see what's going on. Forces are gathering against the housing market. So very interesting. Sales in most major markets weakened in September amid a surge in new listings and softer demand. And now mortgage rates are on the march higher amid the global bond market rout. So what's really interesting, let's go over what is going on in the bond market. So if you look at the front end, not much movement there. But if you look at the 5-year, which is what the mortgage rate is at least in part based upon, it's at 4.25%. That's down from around 4.5% the high. But here's the interesting thing. The inversion between the 2 and the 10 is still absolutely massive. I mean, the 10-year is at 4% and you've got the 2-year at 4.8%. Compare that to the United States, where you've got the 2-year at 5.1% and then you've got the 10-year at 5%. So you've got like 82 basis point spread in Canada and you've got around about a 10-15 basis point spread in the United States. So that is showing you how bad the Canadian economy is compared to the United States right now. Now, I think really a lot of what's going on in the bond market is just unwinding of trades on the long end of the curve, essentially, because those trades on essentially rates being cut by the end of this year, and now that's essentially being priced out of the market, and that's what you're seeing. And that's at least my take on what is happening with the long end of the curve selling off so bad, because the long end of the curve is more susceptible to things like that happening. So let's continue on here and see what they're saying. Canadian government bond yields have risen to their highest level since the financial crisis in recent days. Oh wow, that must mean there's not going to be a financial crisis this year, surely. Anyways, and this rise could pose a big risk to the economy through its impact on the housing market. Yeah, well, at least they're being honest about it, because we know the housing dependence in Canada is astronomical. We've got developments that are going into receivership. Think about all the people that work on those developments and are now out of a job. We've got unemployment claims that are trending higher. We've got disqualifications at the highest level since the late 1990s. We got a yield curve inversion that compares with the early 1990s. The 1987 stock market crash, Black Monday, could be around the corner. So I don't know, but it's incredibly interesting what's going on. So let's continue to see what they're saying here. So last week, 5-year bond yields rose to 4.4%. As bond yields leave fixed mortgage rates, the increase implies that the lowest available 5-year fixed rate could rise to 6.25%. That's a 150 basis point increase since April, which Brown says is equivalent to a hit on affordability of about 13%. But you've just got to think about the hit on sentiment and how people are feeling right now, because even if you're getting into the housing market right now with these high rates, what are most people thinking? They're thinking that rates are going to come down, the environment is going to improve, we're just going to go back to the way it's been for the past 10-20 years. And even though I kind of agree with them that rates could come down, that could be very short-lived, and that could be coupled with massive amounts of inflation that is equally destroying those people as well, because everybody is left exposed to inflation, especially those who have high debt service ratios, which is most people in Canada. They just cannot absorb these high amounts of inflation, obviously. So it leads to a sticky situation. And then if you have that coupled with unemployment going up, essentially because people are so dependent, their debt service ratio is so high, they need a high amount of income to service their debt. So even if they lose one income, that just completely messes up their housing situation. They can no longer afford the housing payment, let alone everything else, the car payment, everything else that has been financed, because we live in this economy where we finance everything essentially. It's just been the way it has for the past since 2008 essentially. Local real estate board data out this week show a surge of new listings with fewer buyers in September, putting the average sales to new listing ratio across Canada's largest cities lower than in the trough of 2022 when prices were falling. And you can see this with the sales to new listing ratio and house prices in Toronto, Vancouver, Vancouver, Montreal, Calgary, and Edmonton. And you can look how we're going down now to essentially what happened in the financial crisis. Think about it. Think about the situation we were in 2008, 2009. They were cutting rates back then. They are not cutting rates. They're debating increasing rates right now. Obviously, we've had the rate announcement that came today, but that is highly irrelevant in my opinion, because it doesn't matter what the Bank of Canada does. It doesn't matter if they increase another 25 basis points. It doesn't matter if they cut 25 basis points. 25 basis points isn't going to do nothing. It doesn't matter if they're holding for the next 4 meetings. There's all this speculation on what the Bank of Canada does next, but really, we've already gone way past essentially where we would have needed to be to avoid this type of thing, which would have probably been around 1.5%. We're now over triple that. So it's just kind of crazy when you really think about it. So anyway, it's interesting. Toronto Dominion Bank economists also see more pronounced and extended downturn for the housing market than they envisioned in June because of rising bond yields. So Toronto Dominion Bank, they're coming out saying that they expect extended downturn for the housing market. So that is interesting. So anyway, let's shoot over to Wolf Street. The splendid housing bubbles in Canada. Prices drop further as sales slow with new listings jump further. The home price benchmark index is down 14% from the peak in March 2022. Toronto down 15% after a wild and woolly sucker rally over the spring. And I totally agree with him. I've been calling that since last year. I said that that's going to come. I won't get everything right, but I certainly got that right. The Canada home price benchmark index for single family houses fell for the third month in a row in September by 1.3% from August, after having dropped by 1.1% and 0.5% in the 2 months prior to 815,300. And then he goes on to show essentially what's happening, charts with Canada's housing market. So you can see essentially this is following the exact chart that you would expect to see with a bubble. So it's very, very interesting. And you know what's also interesting is you've got people coming out and saying the cooling housing market could spur the Bank of Canada to cut rates sooner. Just think about what they're saying here. I think this is utterly ludicrous when you really think about it. But the thing is, the Bank of Canada, if they believe increasing interest rates is going to bring down inflation, then don't you think that they believe that decreasing interest rates is going to bring up inflation? So are they really likely to do that? Not really. Not unless you're getting deflation. Are they going to come in and do that? Especially when they know essentially where we are right now, even though it's high for the past 10, 15 years. If you go back further than that, 50, 60 years, these are not high interest rates. And back then we didn't have a highly manipulated CPI. I could argue that we need interest rates 10%, 15% by the Bank of Canada's metrics, because the Bank of Canada, they believe that we need these higher rates. We need to get these rates way above the inflation rate, and the inflation rate as measured by the CPI is just not accurate at all. So it's interesting what's coming out. You're probably going to see more and more narratives and stories coming out, and they're trying to add hope, I think, to what happens. But essentially, if you go back to Wolf Street, you can see that rent inflation in Canada spikes to the highest since 1983 amid spike in population. Home ownership CPI remains red hot. So if you look at the rent CPI, you can see how this thing has gone absolutely parabolic. And he highlights the Bank of Canada, which has been citing housing inflation as one of the factors in its rate hike decisions, has contributed to this inflation in the housing sector by repressing interest rates and massively engaging in money printing until it had a change of mind when inflation began to rage. And essentially you can do that until you get the inflation. When you get the inflation, that marks a fundamental change in the business cycle and in the inflation cycle as well. So it's incredibly interesting what you're seeing happening with inflation there, specifically the rent portion of the CPI. So if the Bank of Canada is keeping an eye on this, and this is part of the reasons why they're hiking rates so much, then why on earth do you think they would come out and cut rates? Don't you think that is kind of a stupid narrative to pursue right now, considering everything that's going on? But anyway, now I want to show you some examples of the bubble in Canada and how this just kind of blows it apart and shows you just how bad it is. So we're here on Zillow, and I want to show you this house, which is in Delta, which is 1.4 million for this house, which is, you know, pretty standard. You know, it doesn't look like anything special. 1.4 million for this thing. I know it's absolutely crazy, as you're probably saying to yourself right now, but it's it's really close to this house. In fact, this house is just a 10-minute drive from that other house, but you are in Port Roberts in Washington State in the United States. And essentially, the house price is much less. And I've actually done all the math for you here so you can actually see the difference. And I've brought it back to income to be really fair about this, because like I said, the number one fundamental for housing, in my opinion, is always going to be income. So if you look at Port Roberts, the median household income is 61,000 US, which is around 84,000 Canadian. And in Delta, BC, the household income is around 108,000 Canadian. So the household income in Delta, BC is 28% higher. So do you think that that makes up for the more than 70% increase in prices? Doesn't that kind of show you how it's a bubble in Canada? And it's not just here between Delta and Point Roberts. You've got the same thing happening with Windsor, Ontario, and Detroit. We'll get into that. I've somehow lost the examples, but I've still got it written down what they were. And we'll also take a look at what's happening in Niagara Falls as well. So I will just read off to you about the Detroit one. So in Detroit, the average household income is 50,000 US dollars, 68,000 Canadian, and the Windsor household income is 104,000. So the average household income is 53% higher in Windsor, but housing prices are 104% more. So once again, when you look at it through the lens of income, which is what you should always look at housing through to get a true understanding of value, to understand whether it's in a bubble or not. And essentially you can see that the housing price growth is way, way higher. Now, a lot of people will say, Luke, Detroit is unsafe. It's not a nice place. Windsor is a shithole. I've been to Windsor and I've also been to Detroit. In fact, I was in Windsor and I went to Detroit in the same trip. I have a cousin who lives in Detroit, and it depends where in Detroit. There's bad and good areas to every city in America. You know, Detroit has its bad areas, but it also has its extremely affluent and wealthy areas as well. And you know, the comparison that I made for this was a multi-family residence in Detroit that had been renovated compared to just a standard house in Windsor. Obviously, the multi-family had way more potential as well for investment income. So why isn't it selling? And why is there such a price disparity between the two? And that's kind of the thing that you continue to see as we go along here. So this is in Niagara Falls, Ontario. It's 599,000 Canadian. And then obviously, if we flip across the border here to Lewiston, 250,000 US for this house in Lewiston. And they're very similar houses, that neither of them are renovated. This is on a bigger lot, I believe. And if you look at basically the incomes, once again, I will read this off to you so you can see. So basically in Lewiston, the average income is 55,000 US, which is 75,000 Canadian, compared with the average household income in Niagara Falls of 90,000 Canadian. So it's 20% higher in Niagara Falls on Ontario, yet the prices are 75% higher. So once again, why are the prices so much higher considering the incomes? Yes, they're higher, but they're not that much higher. So obviously there's something going on there that you have to think about. There is a reason why these prices are so different, and it's because Canada is in a massive housing bubble compared to a lot of these places which I've just shown you in the US are not in housing bubbles. There are places in the US that are in housing bubbles right now, but they're not these places that I've just shown you. And that kind of shows you how, yes, you can have affordability in housing. And you know, it's not just about population growth. We're seeing new listings surge and supply surge right now. It's obviously not just about that. It's about a raft of different contributing factors. But the main one that comes along with anything when you have rates drop down and people encouraged to borrow is going to be speculation. And that's what we've seen, speculation. And it's just morphed into the Airbnb speculation over the past 3, 4, 5 years. But before that, it was everybody buying these rental properties. But the thing is, people have just continued to lever up. So even though they've been getting that rent income and paying down the mortgage, they've then thought, well, now we've got this equity, so why don't we take that out and buy another home? Or why don't we do a cash out refi and then buy another home? And we're just going to be rich if we keep doing this. And that's what people have done. You can see it with the mortgage debt chart. There's just been this exponential growth essentially in mortgage debt. There hasn't ever been a flattening in the past 10, 15 years. So that kind of shows you the bubble that we're in and what it's been funded by. and it's been funded by debt. The income growth has not backed that up. And doing a comparison like this really shows it. You can't deny it when you see these different houses and how they're priced so differently. Obviously, why doesn't somebody just go across the border and buy that house in Port Roberts? It's 10 minutes away from each other. They could get a Nexus, they could live down there for 6 months of the year, come back for a month, live down there another 6 months of the year, whatever. They could even apply for a visa if they've got family or whatever in the United States. But why aren't people doing that? It's all to do with the availability of credit. And I believe a lot of that has come from the low interest rates. It's come from the moral hazard from things like the CMHC that just increase over time, and more risk is took on essentially by the taxpayer and the banking system. And that's essentially what we've seen in Canada. So I hope this comparison kind of helped you. But anyway, I want to thank you so much for watching. If you've enjoyed this video, you might like this video here, you might like this playlist here. If you're looking for a VPN to get around Bill C11, which you desperately need, go to expressvpn.com/marketmania. That's the VPN I use because it's the best VPN. Anyway, I will see you in the